Hi everyone, and welcome to this special webinar event, during which I will be speaking to Peter Folds from Washington Brown about the very important but sometimes neglected issue of depreciation. The end of financial year is rapidly approaching, and it's that time of year when many people with investment property start to panic and desperately seek an appointment with their accountants. If that sounds like you, then this webinar is definitely one to tune into. One of the core issues for property investors to address at this time of year is how to maximise deductions to save on tax. And one of the best ways to achieve that is to claim depreciation allowances that are available. Today, my guest is Peter Folds, Washington Brown, who knows more about this topic than anyone else in Australia. So, Peter, welcome.
Wow, what a glowing introduction. Thank you very much, Terry. Thanks for having me on again. Always look forward to our chats, and thank you everyone for joining us today too.
Okay, so I think the format today is, and what you plan to do is address the 10 most commonly asked questions that you get, or Washington Brown gets, about depreciation issues. And I just want to point out to people that Peter's going to go through this with a presentation, the most commonly asked questions. But if the question that you have aren't one of those 10, then please give us your questions as we go through the presentations by typing them into either the chat box or the Q&A panel, and we'll do our best to answer as many of those questions as we can as we go through the next 60 minutes of this webinar. So Peter, over to you.
Thank you very much. So Terry mentioned that if you have any questions as we're going along, please pop it in the chat box. And ask. It's a lot more enjoyable, and hopefully it adds even more value to you if we can address questions as we go along and you get your input. That's really what's driven the format of the presentation that I've compiled today. It's pretty dry in terms of animations and colorful graphics, but what we typically find at this time of year, very much in our June 30 end of financial year rush, is that people might be thinking to ask questions, don't feel sort of confident in asking those questions. They don't have the opportunity to ask the questions, or it's a case of that in this situation where we've been asked the question so many times before that we want to make sure that we're publicizing that before it needs to be asked again. So that's really the plan for today's session. There are sort of 8 of the most frequently asked questions, the most relevant. So hopefully as we go through that, it'll address some of your questions. But as we mentioned, please feel free to ask any more if I haven't touched on something. So might jump into the presentation here. You can see that all right at your end?
Yep, it's all pretty clear.
Good. Okay. So these are the 8 questions that I thought we'd cover today. In no particular order of importance, but as I said, these are the ones that keep coming up, and it's important for people to know. All right. So very, very common one, and probably the obvious question you might think we get asked, specializing in tax depreciation, is what exactly is a depreciation report? The context for that question is usually, in my experience, it's, oh, look, my accountants told me I need a depreciation report. I don't really know what that is. They told me to call you. It might be, a friend of mine said they got a depreciation report from Washington Brown, and it saved them, thousands of dollars in tax. So I thought I'd call and see whether I need one. It's my sister's partner's dentist got one done, and they said I should speak to you. So that's first cab off the rank. So what is property tax depreciation? What is a schedule? Well, it's a legal tax deduction related to the wear and tear of an investment property over time. I know that seems funny because when we buy an investment property, we're wanting, if we've done it properly and we've bought in the right place, we've relied on data from reliable services, and we've used professionals to ensure we've bought the correct property, it should go up in value. But from a tax perspective, it's the land that's going up in value. The building is seen as losing value over time as it's getting older and as it's being used. To be able to claim depreciation, the property must be income producing. So it has to be available for income generating purposes, cannot be owner occupied. We also get asked this as I guess a sub question of this is, is it to do with the value of the property? Are you valuers? Well, no, we're not. As quantity surveyors specializing in tax depreciation, we're not able to value the property as such. Depreciation is all about what the construction cost was, the original construction cost. And we're accredited and recognized by the ATO as being able to estimate those construction costs where the original costs are not known. If you buy a second-hand property, you're not expected to have any knowledge of what the original costs were, and that's where we come into the picture. All right, so there are two components that we look at when we're assessing a property for depreciation benefits. In summary, that's the plant and equipment component, and then there's the structural component. So plant and equipment are your appliances, things like carpets, door handles, air conditioning. We sort of generalize and say that if you could flip the property upside down and give it a shake, anything that falls is typically plant and equipment. That's a very general overview of it. The structure then, quite obviously, is the concrete, the bricks, the timber. It's many people don't realize that this also includes the internal structure. So things like cabinetry or tiling within the premises itself. Our reports include two methods of calculating depreciation. They are the diminishing value and the prime cost methods. Now, diminishing value, as you can see here, it weights the bulk of the deductions in the early years. Most investors go with that option because they want to claim, increase their capital and cash flow earlier in the piece. And so claiming the most deductions earlier on is how they achieve that. There are some times where the prime cost method or straight line method, as it's sometimes called, will be the better option. And that just averages out the deductions over the effective life, usually over the 40 years. At the end of the day and the end of that effective life, there's no advantage. You're not getting more deductions by choosing one over the other. In terms of what our output is and what a tax depreciation schedule is, these are a selection of pages from the report. So what you're purchasing or what our clients are getting from us when they engage our services is an assessment of the depreciable value of all of the eligible assets within that property. We're then compiling a detailed report, so you can see each of these items listed, which shows their depreciation or effective life, and what the opening written down value is. So where we've estimated the original cost. The most important one, and the one that our clients are most interested in, is the summary pages. So this is the diminishing value method and the prime cost. And don't worry if you can't read the figures here. The important thing is just to highlight the format and to show you that the report is detailing, in this case, for a brand new apartment, 40 years. So each of these lines represents one financial year of how much in deductions you can claim each year for depreciation on that property.
Peter, is it fair to say that for people who are looking at that and saying, oh my God, I'll never understand it. Is it true to say that you don't actually need to understand it? You just need to give it to your accountant?
Absolutely. Absolutely. So as I mentioned, Terry, this looks very, very complex and detailed. There's no real input needed from the investor, the property owner's perspective here. One of the questions we'll come to later talks about what is needed at the start. But in terms of what you do with this report, you simply give this to your accountant. Over our 40 plus years of existence, we've really fine-tuned our reports now to make them as user-friendly and as easy to work with for accountants. So this report contains everything they need to go through and ensure you're claiming the maximum depreciation deductions on your investment property. As I said, these two pages are probably the most popular in the reports because it's a summary of all of this sort of complex and detailed data So, great, Washington Brown have allowed me in this case to claim a $20,000 tax deduction this financial year. So that's a good segue to move on to one of the most frequently asked questions we get is, how does a depreciation schedule help me or benefit me? What value is this to me? It helps you pay less tax. That translates to better cash flow and more money in your pocket. So depreciation reduces your taxable income. Often when I say to clients, look, you're eligible for a $5,000 tax deduction or depreciation deduction, they're like, great, this is $5,000 in my pocket. It's not the case. The actual benefit will depend on your marginal tax rate. But if I walk you through this example, so without depreciation, if I earn $80,000 and I'm taxed at 37%, so the simplified equation here is I pay 37% of $80,000, I'm paying $29,600 in tax that year. Now, using the same figures, if Washington Brown's report says that in this financial year, there's a $17,000 depreciation deduction, the equation changes for the better. Your tax then you pay your tax on your $80,000 minus your $17,000 tax depreciation deduction. So you're only paying 37% on $63,000, not on that $80,000. Now in this simplified example, you're paying $23,300 in tax compared to the $29,000. So the summary of this example is that by claiming your $17,000 depreciation deduction, you've actually saved tangible money in your pocket, $6,290.
And Peter, do most people, when do they actually get that tax refund? Can they actually claim it on an ongoing basis throughout the year, or do they, at the end of the year when they do their tax, they get a tax refund?
Look, in the vast majority of cases that I know on, it sort of comes in as a refund at the end of the year after the tax lodgement. I have known in the past of people who've organised I believe a tax variation form to allow for that. So some of that benefit comes to them throughout the year.
Okay.
Certainly a question to discuss with your accountant. All right, moving on to number 3. In May, if you've watched or heard me speak before, watched one of my chats with Terry before, you've heard me talk a lot about the tax legislation changes that occurred in May of 2017. Unfortunately, because it wasn't so well worded, or wasn't so clearly worded, and what a surprise that a government body released sort of communications that weren't so well explained, particularly a tax office. What came out of that legislation change was a lot of confusion, but it's led a lot of people that are sort of not directly in the depreciation industry, but related to it, to believe that if the property is older, so not brand new, that there's no point or no deductions to be claimed, and it's simply not true. So in common scenarios, if your property is brand new, and you purchased this after May 9th of 2017, if the property is brand new or was brand new, and it has not been owner occupied for any duration, you can claim depreciation on everything. Remember those 2 components I told you that we look at, the plant and equipment and the structure? In that scenario, you're able to claim the maximum deductions on both, and your deductions will occur yearly for the next 40 years. If your property was built after 1987, you're still eligible to claim deductions on the original structure. Because they occur for 40 years, there's still a number of years left until it hits that 40-year mark. So in those cases, it's definitely going to be worthwhile getting a depreciation schedule. So built after 87, you can claim on the original structure. You can also claim on the structural component of any previous owner's improvements. Now, when we tell this to our clients, this seems to be a very little known fact within the industry. So if you purchase an older property and it's had a kitchen renovation or a a bathroom renovation, you can see that it's been painted and there are now downlights in the property, or there's a new deck or an awning. You as the new owner, even though that property is older, secondhand, you're able to claim on the structural component of the previous owner's improvements. And as quantity surveyors, it's our job to work out what they are, when they were done, and what the value was, the original construction cost of those was. Now, if your property was built before 1987, many accountants, property managers are telling clients, no deductions available. I would urge you to contact us and to ask. We'll happily produce a free estimate for you. This way you can be guaranteed, you make sure that you're not missing out on any deductions. As I said, very, very likely that a property built before 1987, if you've purchased that now or recently, chances are you paid a mozza for it in most places within Australia. It's very, very likely that it's not going to be in original condition, that previous owners or many of the previous owners have made improvements. You are still eligible to claim on the structural component of those. Often that relates to thousands of dollars in deductions each year for a number of years. It starts from 40 years from when that particular component was deemed to have been done. Let us check that out for you and make sure that you're not missing out on things. And obviously, even if it's a new property, it's an older property, you can still claim on any renovations that you have done as the current owner. The asterisk there and the caveat is that the property must not have been owner occupied for any duration. You cannot be living, the property cannot be your principal place of residence while you're doing those renovations. It's likely then the ATO will see them as previously used, is the buzz phrase. So as long as you haven't been living in the property whilst doing the renovations, and that the property is available for income generating purposes once the renovation's complete, you can claim on the plant and equipment and structure of the renovations you've done. All right, moving on to number 4. This is a bit of a heated topic in our industry over the last couple of years because it's a change to the norm. Now, business processes, all industries evolve over time and react to change. It was really the COVID-19 restrictions that sort of brought this matter bubbling to the surface. And we're one of very few firms that have been so proactive in reacting to this. So previously, it was just what you did. You engaged a premium tier quantity surveyor such as Washington Brown, and there are a few others in our industry. And there was an inspection involved. Now, many people in the industry, related to the industry, property managers, accountants, brokers, even seasoned investors that have done many of these in the past, always had an inspection. It was just included. So now when they hear, well, hold on, Washington Brown told me I didn't need an inspection, they're a bit taken back. Where we're given the opportunity to explain why, it makes sense, a no-brainer, as you will. The fact is, Washington Brown, we don't want to charge for components that are unnecessary. In many cases, there may not be, I should say, any value or benefit in charging a client to conduct an inspection. Now, situations where this would occur, to give you an example, a second-hand property where the investor is now not eligible to claim on the plant and equipment component because as of legislation change in 2017, that component's now seen as previously used. So all they're eligible to claim on is the structural component. Now, if we can be provided or have access to already floor plans and a detailed set of internal and external photos where we can see the structural components of each room, because this is all the client is eligible to claim on, and we can already see everything we need, in that scenario, we wouldn't charge for an inspection. There's simply no benefit or value to the client. We're always running that preliminary assessment. So if we do not have access to more than sufficient data, or we cannot be provided with that if we feel that we do not have a complete picture or absolutely everything we need at our disposal to ensure the maximum ATO compliant deductions, we will absolutely suggest and quote to include an inspection. It's just in many, many cases, it's just not required. We already have access to that data. And that's a big one. It's I specifically wanted to tackle that because feedback's told us that a number of clients have received that it is significantly cheaper because an inspection is not quoted. They're comparing that quote to a number of our competitors. And whilst it's much cheaper, if 2 or 3 competitors have priced in an inspection, one hasn't, it's a very understandable conclusion to come to that, well, I must need one, and these guys, there's something wrong here or dodgy or they missed something. So that's a really important one to consider. Okay, now this is a very end of financial year specific question. How long does the process take? At this time of year, I think to put numbers around it, in the month of June, so 1 month out of 12, we'll do something like 30% of our yearly turnover. So it gives you an indication of how busy we are. And I think that's human nature. We're busy, and we, particularly if it seems tricky or we don't understand it, we tend to sweep it under the rug or push it off. We're also leading increasingly busy lives. So, in August, when our accountant tells us, hey, you really should get a depreciation schedule, it's easy to put that on the back burner. So we get to this time of the year and people are frantically calling saying, gosh, June 30 is coming. I need this depreciation report. How long does it take? It will depend on whether we're doing an inspection or not. We will try for most metropolitan areas within Australia, provided there's no issue with the tenant giving us access, we're usually able to inspect within 3 to 4 days, with the report ready within 10 business days after that. If we don't need to inspect, from receiving all required information from you, we can have the report ready within 10 business days. And there is a guarantee around that. And as far as I know, I think we're one of the only ones, particularly at this busy time of year, to still offer that guarantee. So from receiving all required information and doing an inspection where we've deemed it necessary and you've agreed, we can have the report ready within 10 business days. What causes delays? Now, I've touched on some of these. The tenant being, a bit elusive and hard to get a hold of. The property manager being very, very busy and hard to get a hold of. If it takes a while for you to respond to us with the required information, that will also hold up the process. We cannot reach out and start your report or start organising the inspection until we have everything we need. So that they also cause delays. Now, I should mention, saying 10 business days, I don't want to put anyone off. It's, what are we, the 23rd of June? 10 business days obviously throws us well past the June 30 cutoff. Now, I feel a bit like, those magicians that go on the shows to reveal how they do tricks and how they must be hated by the rest of their industry. So let's keep this to ourselves. The truth of it is you don't actually need the completed report with you by June 30. You absolutely need that completed report by the time you do your tax lodgement. For most people, the tax submission deadline is October 31st, I believe. So you definitely need to have the report before you make that appointment with your accountant to do your tax lodgement. By law, in accordance with ATO legislation, because our reports are fully comprehensive, they must start from your settlement date, and they will show deductions available from the moment your property became income generating. So it doesn't matter that you might only receive your report, a week into July or later. As long as you've ordered the report before June 30, you've paid the fee or the invoice before June 30, if you'd like to claim the fee as a deduction in this financial year, and that's the big urgency and rush, you miss out on nothing. There's no consequence to receiving your report after June 30. All right, so in that last question, I talked a lot about we can't start until we receive that information. And I think feedback tells us that a lot of clients sort of scared to engage us because they're not sure of whether they're going to be able to provide this information or how difficult it will be to provide the information. I do know of some cheaper operators in our industry that won't ask for as much information as we do, and that's fine. You know, for clients that are wanting to, if the main focus is paying the least amount of money for a depreciation report, where we're typically not a good fit there. We want to ensure that we're maximizing the deductions for our clients and ensuring 100% ATO compliance over that potentially 40-year span of the report. Because of that, we want to be thorough. We're not going to ask anything too tricky of you, but we do want to be thorough. So what we'd ask for, you know, with a new built house, typically providing us with the building contract in its entirety will tick off the vast majority of what we need. We're going to need to know the ownership name, the purchase price or the construction cost in this case, the floor plans, the schedule of inclusions. We'll also need to know the completion date as well. If typically clients do additional work such as landscaping, driveways is a common one that comes up, where you've gone and done additional works, you simply need to provide us with the cost and description information for those additional works. Now, for a new property purchased from a builder or developer, so where you don't know the construction cost, or with an existing or second-hand property, where you've got a copy of the floor plan, that's great, helpful but not crucial. What we definitely need, again, as you'd imagine, the ownership name or names, as per the contract. We want to know the settlement date, the purchase price, the details of any additions that you've made. Where we're inspecting, we'll ask for your property manager's details so that we can liaise with them and in turn the tenant, which we're very used to doing. The only other additional helpful but not crucial thing is a strata plan. So if you purchased in a strata titled townhouse complex or unit apartment complex, a copy of the strata plan is helpful too. So this is all information that you have 100% been provided with at some point during the purchasing process. Where you cannot find information, we can often help. So yeah, that's an important one, a very frequent issue to come up. All right, so second last of my pre-planned questions here. When should I get the report done and how often do I need it? When should you get a report done? Well, I sell depreciation reports, so the answer is now. But having said that, what I really mean is before June 30, so that it smooths out our workload. In actual fact, it doesn't really matter. You want to get the report done sooner rather than later, certainly within your first year of ownership. This ensures that it's just a fail-safe to make sure that you're not missing out on deductions. With tax depreciation deductions, it's different to some deductions. You can't roll them over into the next financial year. You can't push the deductions forward into the next financial year. They are specific and only claimable in the financial year that they are allocated to or that they occur in. Whilst you can amend up to 2 years tax lodgements, for everyone out there that's owned an investment property and hasn't had a depreciation schedule done, you can amend up to 2 years, but really you want to get it done, as close to you purchasing, settling, and knowing the income generating start date as possible. Other considerations are that where an inspection is deemed as necessary, we'll try and work in with you and your property manager to get in there before tenants do. Most tenants understand that, you know, trades and services professionals will need to get in there. But we also, you know, want to work with your property management team and ensure that we're minimising any disruption where possible to your tenants. So that's another consideration to think. I've already busted that June 30 myth. The advantage to having the report done, engaging us before June 30, is that you're able to pay and claim our fee as a deduction this financial year. Our fee is fully tax deductible in the year that it is incurred. You will not lose anything or miss out on anything by having the report completed after June 30. You just want to make sure that you've got that with you before you go and meet with your accountant. Okay, now the last one here, well, actually, I will touch on this point. How often do I need to do it? Kind of a bonus add-in. We don't get asked this too often, but I thought it might be valuable to know or to reassure clients. When you engage an accredited ATO trusted quantity surveying firm like Washington Brown, the reports are fully comprehensive. So they span the maximum duration that you are eligible to claim deductions for. So until the deductions run out within that effective life. What this means is our service, the expense for the report, the fully tax deductible expense for our report, is a one-off exercise. The only caveat to that is that if in a number of years' time you go and do a significant renovation, you might want to engage us then to prepare an amended or updated report. Now, you know, within the first 5 years of receiving a report from Washington Brown, if you go and add an item or two, an air conditioner, you put a new hot water heater in, you replace an oven or a stove, where we wouldn't charge to update the report. But where there's sort of over $10,000 worth of work done or more than 10 items, there might be a small amendment fee. That would also be fully tax deductible, and it's a fraction of the cost of the original report. All right, now the final one here, and it makes me laugh because whilst I understand where the questions are coming from, it's sort of a predicament to be in as a business. Sometimes it's not possible to please everyone or to meet everyone's expectations. Both of these questions occur as frequently as the other. Washington Brown were cheaper than some other companies. Why should I choose you, or what's wrong with yours? We also get as often, you are more expensive than some other companies. Why should I choose you, or why are you more expensive? Both statements are true. There are certainly cheaper operators in our industry. There are definitely more expensive operators in our industry. I guess, as I mentioned before, where you are looking to pay the least amount of money for your depreciation schedule, there are probably better choices out there than us. Where the focus is on maximizing those deductions, ensuring ATO compliant deductions. We've been in business, as I said, over 40 years. We produce over 10,000 reports a year. We've never once had any of our figures rejected by the ATO, and that gives our clients complete peace of mind. It's a big part of why clients choose us. This is a list that I know it's very, very wordy. I won't go through it verbatim, but these are some reasons why, despite us being, efficient and more competitively priced than some others, these are why we're one of the leading providers, and why accountants, property managers, developers, and clients alike choose us over our competition. It's got a lot to do with that peace of mind and ATO compliance. You've got to remember that, to apply the we don't want to cut corners. Every report that leaves Washington Brown has had the same level of scrutiny, detail, peer review, and sort of quality assurance processes, as any other report that leaves us. That, as I said, we don't want to cut corners. We make sure that we're competitively priced. We want to ensure that we're offering value, but we're certainly not offering a cheap solution. You've got to remember as well that because the fee is tax deductible, is it worth potentially risking thousands, even tens of thousands of dollars over that 40-year lifespan worth of depreciation deductions for the sake of saving 100, 200 tax deductible dollars, on the initial one-off outlay. Once again, I work for a company that sells and specializes in tax depreciation. Should you ask a salesman whether his product's any good, of course he's going to say yes. I would urge clients to look at who trusts us, who recommends us, what our reviews are saying, and make a decision based on that. We know you're in safe hands, but it's important that you're doing your due diligence beforehand, so that you know that you're in safe hands and making the right decision. Now, that was a lot of me talking and a lot of information to throw at you, as I said, without any pretty pictures or colorful graphics. I did mention earlier that we're very, very happy to conduct a free preliminary estimate. We want to make sure and are happy to look at your property and to assess whether there are any deductions available to you, whether it qualifies for depreciation deductions. If it does, is the amount available to you, worthwhile you spending money on the report? We're also, during that process, going to look at if it is a value going ahead for you, do we need to inspect? If not, even though there might be lower deductions available to you, the fact that the fee, the outlay for the report is lower, might offset that for you. But I want to stress the point that, if you email me at info@washingtonbrown.com.au, you put the subject line as attention, Peter, RE Hotspotting webinar, you give me the property address and ask for an estimate, I will happily look into that for you. It's obligation free. If it is worthwhile, I'll send you over a quote. Just while we're here, if you do want an estimate and a quote, you know that this is something you need to do. Please use that subject line here and email sales@washingtonbrown.com.au with the address, the approximate year of construction, the purchase price, and the settlement date. We'll absolutely run that preliminary assessment and get that quote over to you. And once again, there's still time. Yes, we're 7 days out from end of financial year. There's very much time to request that quote for you to decide whether you're happy to go ahead, whether Washington Brown are the right choice for you. If so, and you accept, still plenty of time to get that invoice out and paid so that you can claim the fee this financial year. So that's all. I'm hoping, or would be happy to take any questions, Terry, if any have come through.
And I urge people to, with further questions for Peter, to type them into either the Q&A panel or the chat box. So Peter, just with reference to the point you made about your willingness to give people a free assessment as to whether it's worthwhile for them to get a depreciation schedule or not. I actually asked you that question myself about 18 months ago when I bought a particular property, mainly for the ability to subdivide the land, but it did have a house on it, which is livable and lettable, but very old. And the answer came back from you that it wasn't worth the fee cost in that case to get a depreciation schedule. So I can certainly attest that you will get an honest answer to that question. But to follow up with that, since buying that property, I've made a number of additions and improvements, a new hot water system, air conditioning units, etc., screen doors, etc. Would it perhaps now be worth considering getting a depreciation schedule done and those circumstances where originally it wasn't worth it because of the age of the property. But now there's been some not massive improvements, but some new plant and equipment's gone in particular.
Yeah, absolutely, Terry. That is definitely time to ask the question. And I'm deliberately saying good time to ask the question rather than a good time to get a depreciation schedule done. The reason being is, once again, in accordance with ATO legislation, because with these items that you've added, you know the cost, that you've got a receipt or an invoice, the cost, date, and item are known. Your accountant, where these bits of information or data are available, your accountant is able to calculate the depreciation deductions on those additional items. Where they feel comfortable and competent and willing to do that, you don't need to engage a quantity surveying firm. Whilst I don't like turning away business, the fact of the matter is if it's only a couple of items and you haven't had a depreciation schedule done with us for that property beforehand, it may be more cost efficient or cost effective for you to speak to your accountant first to say, hey, look, these are the items I've purchased. Are you able to work out the depreciation on these?
Okay, great. So we do have some questions that people are now starting to put into the Q&A panel and the chat box. Clara's asking, case where a property was in need of renovation was purchased. The renovation was not done. In the meantime, the property deteriorated to the stage of needing to demolish it and was demolished recently. It's now due to be rebuilt. Can any depreciation be claimed on the loss of the building that was demolished?
Potentially. That's a very specific question, and one I would love to deal with and look into the specifics of offline. So did you say, was it Clara?
Clara. Yeah.
Clara, sorry, my apologies. Clara, please email me or get in touch. I'd love to look into that a bit more for you. It's very likely, depending on the age of the property, that there might be some sort of residual write-off that is achievable, but there are a number of factors to consider. It's certainly possible. Please get in touch. I'd love to look into that for you.
Yeah. So Tisha's asking a question, which I think a lot of people might also ask. I've rented out this property and claimed depreciation for 5 years. Now we're selling it. Do we have to give some of that money back to the ATO when calculating the capital gains tax?
Yes, great question, and certainly beyond the basics or the 101 of depreciation. Yes, you do. Should this revelation turn people off getting a depreciation schedule? No, and here's why. Of the two components that I mentioned on one of my earlier slides, the plant and equipment component and the building or structural component, you only need to factor in, if you sell, you only need to factor back in the portion you've claimed on the capital works for the structural component. So anything you've claimed on the plant and equipment side, is claimed, done and dusted. You don't have to pay any of that back. So if we focus in on the capital works of the structural component, yes, you do have to factor that back into the capital gains tax equation. But in Australia, we're very lucky to be eligible for the 50% capital gains tax reduction or allowance. So even though you might have claimed, and this is not financial advice by any means, just an example, even though over 5 years you might have claimed $20,000 in deductions against the structural component, because of that 50% allowance, you're only needing to factor back in half of that. So the 10,000. So you've benefited from a yearly increase in cash flow by maximizing your deductions. If you do sell in the future, and that's an if for most people when they purchase a property, yes, you do have to factor in a portion of that, but it's only half of one portion that you've been claiming on. So you're very much still better off. Most investment strategies, for the vast majority of us, involve buying and holding. Sure, there's always the chance that a property might need to be sold or strategy might shift, but we would suggest that you're probably better off maximizing your cash flow and increasing your deductions now while you own the property, rather than waiting for holding off for an if or a maybe selling the property in the future.
Is it fair to say that the depreciation claims can convert a negatively geared property into a positive cash flow one?
Yes, that is fair to say. And there are a lot of other ducks that need to be in a line, in a row, and a number of other factors that will contribute to that. But absolutely, it's certainly one possible means of achieving that, or tipping a property over from you having to fork out money for the ongoing cost of holding, versus it either being neutral or paying you. In one of my examples, I said that when I was talking about how depreciation benefits you, showed that particular example equated to an extra $6,000 back in the investor's pocket at the end of the year. That's often enough to push people into a property being positively geared, particularly now with interest rates so low.
Another question. A couple of years ago, there were some major changes by the government to depreciation. I think that was 2017, wasn't it? Have there been any more since that we need to be aware of?
No, thank goodness. There have not. After that announcement at 7:30 p.m. on Tuesday, May 9th, 2017, burnt in my memory now. Certainly everyone in Washington Brown and very much so in our industry weren't actually sure whether we had jobs to come back to, or a service to provide after that. So that was a pretty major change, and certainly not expecting anything significant in the near or foreseeable future. Important to mention, we don't have a crystal ball. We can't say certainly that there will not be changes. What we can say is every time there has been, the government have grandfathered those changes. So if you had purchased your property beforehand, you were not, and it was, in this case, purchased the property beforehand and it was already income generating, you were not affected by these changes. So that's some reassurance moving forward, without absolute certainty. The other change that got proposed that would have affected things slightly was when government sort of suggested or proposed that they would abolish negative gearing. Second time in the history that I know of that's been proposed or attempted. And like the first time, although this one didn't have to be repealed, it didn't get to that point, it wasn't successful. So certainly no changes on the foreseeable horizon.
Okay. And yes, people are out there watching and listening. Any questions? Now's the time. We've got about another 10 minutes left before we get up to the end of our 1 hour presentation. So please let us have your questions, type them into the chat box or the Q&A panel. And a question from me, Peter. I've been sitting here smugly thinking, well, I'm covered. I've got all my depreciation scheduled. And while I've been listening to it, it's occurred to me that on a particular property, not too far from where I'm currently sitting, I've done some substantial renovations in the last 6 months. So I already have a depreciation schedule for that property, but I probably need to update it.
Yeah.
What's the process there?
Okay. In that case, an email to myself, Terry, the info team, and address to me. You'd simply need to say, hi Peter, or hi team. Back in June of 2018, you prepared a depreciation schedule for my property at the address. If you've got our job number that came with that, that'd be very helpful too. You then need to say, look, I've done, $30,000 worth of renovations. I'd like to update that report. Please assist. What we do then is probably get back to you and ask for a little bit more information and a breakdown of what was done. We confirm whether there's an amendment fee or not, and indicate to you how long it would take to produce that amended report. And then you decide whether you're happy to go ahead with that by accepting that quotation. And within 10 business days of you saying yes, you've got your updated report ready to increase your tax deductions.
Okay. Now, Sandeep has raised his hand, and that means that perhaps Katie, you might be able to, Katie's sitting in the background there making everything work properly. You might be able to unmute Sandeep so he can speak to us directly, perhaps.
You can go
ask
ahead
this
and
question.
speak now, Sandeep.
Hello, Sandeep, are you there?
Showing up as Sandeep being muted on my side, guys. For Sandeep and for anyone else, if you're not sort of confident asking the question now or not sure, you want time to think about it, perhaps I'll put my contact details back up on the screen so that if we don't get to your question now, or even if you think it's
He's actually now typed this question into the Q&A panel, Peter. He's asking which method is the best prime cost or diminishing value. I suppose there's no one correct answer to that question.
Correct. So it's, as I mentioned, at the end of the effective life, the duration that you're able to claim depreciation on that property, Sandeep, there's no difference. Okay, the amount of deductions will be the same over that period. Which method you choose will be very much specific to how long you've owned the property before it became income generating. And also it might depend on your investment portfolio, and your tax structure, and your marginal tax rate. So it's absolutely something you're going to want to discuss with your accountant once you've got the report. I can tell you two things, Sandeep. Most investors will start claiming or choose to utilize the diminishing value method because they want to claim more deductions sooner. It's a more benefit to increase cash flow and increase deductions in the earlier years. That is the vastly more popular option, but it's not necessarily the right one for everyone. I can tell you that a report from Washington Brown, because our reports, once again, are fully comprehensive and ATO compliant, our reports include both of those methods as standard. So you do not need to know this when you engage us. The report by default will include both methods. When the report is provided to your accountant, he or she and yourself can have a discussion about which methodology works best for you.
But Sandeep and others, if you do have further questions, follow-up questions, something that hasn't been answered today, please make contact with Peter via the method on the screen, particularly info@washingtonbrown.com.au. Rex is asking, and I think you touched on this earlier briefly, Peter. Rex is asking whether valuations affect depreciation reports.
A fantastic question. I did briefly touch on it at the start, and it's a very, very common misconception or question to ask. Property valuing of valuers are a different, separate science and separate kettle of fish to us as accredited quantity surveyors. In terms of depreciation, we are basing and must base it in accordance with ATO regulations, base it on the original construction cost, what it cost to build at the time of the original build, and then any renovations that occurred in the past. So that won't change over time. The original costs are the original costs. Whereas with a valuation done by a registered property valuer, they're factoring in things like demand, supply, the area, the worth of the property, not what it costs to build. So separate kettle of fish, with the short answer being no, the valuation is separate to the depreciation.
Okay. All right. So once again, and Rex is saying thanks heaps. So I think you gave him a great answer to the question. We're just getting very close to the end of the hour, so I would urge anybody who has any further questions, follow-up questions, just wants to explore whether it's worth getting a depreciation schedule done for a particular property you have. Please make contact with Peter and his team through was info@, wasn't it? washingtonbrown.com.au. Thank you. Yeah, there we go. Make it easy for people. So thank you, Peter Foltz from Washington Brown, for once again an interesting and informative discussion. I always like doing these webinars with you because you make a potentially boring subject interesting and convey, I think, to people watching and listening just how important it is to consider what you need to do around depreciation schedules.
Well, I'm grateful for the kind words, Terry, and I certainly hope it's been of value. It is a potentially dry subject, but when you consider what it achieves, that it is saving property investors money. In our case, we would never charge for a report that didn't represent a benefit to the client. It's easy to be able to convey information about a beneficial service such as this. And I certainly hope the explanation and questions covered have assisted everyone that joined us today. Thank you very much for having me.
And I think that the case study that you put up early in the presentation with somebody on just an average income with a fairly average property can potentially reduce their tax by, in that case study, by $6,000 or more, just by applying the depreciation allowances that are available.
Yeah, and look, and just on that, even if the property, I think there was, in that example, there was $17,000 in deductions. So that would be a relatively new property. Even with an older property that's had a renovation of, it's been painted, it's had some landscaping works, a deck, an awning, kitchen and bathroom, there may still be sort of, even $2,000 to $3,000 worth of deductions each financial year. In those cases, we may not need to inspect, bringing the report cost down to, $500 GST inclusive or potentially less. It's still worthwhile going, even though the deductions aren't as high each year. You're still looking at 20 or 30 years worth of those deductions for that one-off tax deductible expense.
Perhaps time for just one more question before we finish up. Clara's come back in and just asking how far backwards in years can reports be made or claimed?
Two separate questions, Clara, and both good ones. So again, our fully comprehensive ATO compliant report format means that the reports will always start from when you settled on the property. So that no ifs or buts, it wouldn't matter whether you settled yesterday, or 10 years ago, the report must start from your settlement date. The report will show the deductions you're eligible to claim, the depreciation each year from the specific date, or our report showed from the specific date it became available for income generating purposes. Once again, that might be yesterday where you settled yesterday, or it might be 10 years ago where you settled 10 years ago, or it might be that you lived in it for the first 5 years and then it became available for income generating purposes. So that it doesnto matter how far back to answer that side of it. The second part of the question is how far back can you claim? And to reiterate, for most individuals in normal circumstances, the ATO will allow you to amend the previously lodged two tax years, so 2 lodgements, to allow for depreciation deductions and other sorts of amendments, but they'll let you go back 2 lodgements back. So my suggestion is, if this is in your case, Clara, or anyone else out there, and you think that you might be eligible to claim deductions for previous years, do not submit your this financial year's lodgements until you've looked into it, because if you do lodge it this year, that's one of those 2 years that you can go back, take it off. So my suggestion would be to, in that scenario, to look into it before you do your lodgement.
Okay, so it means, Peter, that you lodged a tax return 2 years ago, got a refund of $2,000, but realising there's some claims you could have made but didn't, you can actually amend that and actually get further tax back from that year 2 years ago or 1 year ago. So what
Absolutely.
Yeah. Okay, well, I think that's great to know.
Yeah, a fantastic question. Thank you.
Yep. Okay, well, thank you, everybody who have submitted their questions. Hope you found the session today and the answers that Peter's given helpful and useful. I'm sure you did. I've, as always, found it very educational, and it's also alerted me to the fact there's something I need to do about updating and amending some of the depreciation schedules on properties that I have. Anybody wants to follow up, and we urge you to do so, contact Peter and his team by email at info@washingtonbrown.com.au. We'll send a recording of the webinar to everyone who registered for today's event, including those people who weren't able to watch it live. And we'll also have information about how you can follow up if you have further questions or problems to deal with. Thank you again, Peter Folds from Washington Brown, for a great presentation. Let's do it again soon.
I look forward to it, Terry. Thanks for having me. Thanks for joining us, everyone. Look forward to hearing from you. If I can assist in any way, thanks a lot.